Hello, and welcome to the Victory Loves Company podcast. Today is Monday, March 12th, 2018, and I'm Conrad. So you've crunched the numbers, thought about the lifestyle, and made the decision to buy a home. But it can be a complicated and stressful process, as we all know. But knowing what to expect can reduce some of that anxiety and help you find your home a little more easily. And to help us with that, I am joined today with Luke Frezza, a mortgage banker with Homeland Lending. He's been facilitating and helping people with the process of purchasing a home for well over 15 years now, and is currently a father of 4. And without him, we would not be sitting in the room that we are now, as he has been my personal broker in the current home that I have now. Luke, welcome to the show, my man.
Thanks for having me aboard.
That is one fine shirt, I'm going to tell you that.
A little bright today. It's okay, thanks. Thanks for having me again.
My pleasure. So, Luke, why don't you tell us a little bit about yourself, your professional and your personal background, please?
Sure. I mean, you've kind of filled the viewers in. I have about 15 years in the financial services industry. About the last 9 have been with specific to the mortgage industry. Married, 4 children, ages from 12 down to 1. So that last one was a little boy. So I think we're done now at 4.
Congratulations.
Thank you. Lifelong Bergen County resident. And my current company is Homeland Lending. We're based out of Hackensack, New Jersey.
Okay, cool. So what made you choose this industry?
I guess you could say it chose me. I've been in banking about 14, 15 years. Kind of had a cup of tea with everything in the banking, small business, investments. I really kind of found my calling in the home mortgage process, helping people get from point A to point B, get into their new home, build great relationships. And so that's kind of how I started and why I chose to stay in that industry.
And you are a mortgage broker, correct?
Up until a year ago, that's correct. Within the past year, we actually changed over to a mortgage bank. So basically the designation with a mortgage banker versus a mortgage broker, the banker is cutting a check from their own account essentially. So if you get a $300,000 loan, right now Homeland Lending will be writing a check for $300,000. You'll be repaying the $300,000 to Homeland Lending. Albeit we might sell it to an investor, but a mortgage broker from the start will actually go out and find multiple banks and sell your loan to them. So their best interest is to find the best deal for you. We might shop you around as a mortgage broker, more than up to a dozen companies or so. Where a mortgage banker, they're cutting the checks from their own accounts.
So there are many steps, obviously, in purchasing a home. Lots of pieces of information that are out there that should be fragmented, in my opinion, meaning that a first-time home buyer should look in multiple places to get the information they need throughout the home buying process. At times, I can tell you from experience that this lengthy and often convoluted research process can deter a first-time home buyer from purchasing a home or the home buying process. So where do you fall in the home buying process, like steps?
Ultimately, I wish to be the first person in the process. And the reason I say that is if you're looking at a home, 300, 400,000, et cetera, whatever your budget is, I think it's best to know what that budget is, what you're going to be paying monthly, and more importantly, what you're going to get approved for. You don't want to be looking at 10, 20 houses in the $400,000 range only to find out that 350 is your cap. Your realtor's going to love you a lot more if you go into the process pre-approved. That's why I think a mortgage banker, mortgage broker should be ultimately the first person that you do see in the process. They're going to give you a better idea of what you can afford and kind of put you in the right perspective on what your budget is and what you should expect to be paying.
What should people know when selecting a mortgage broker?
Okay, so with someone like myself, I typically handle 5-6 loans a month. Back when I was at a big commercial bank, I had about 20 to 30 files. I had processors in one state, underwriters in another state. So the loans were really all over the place. That's kind of why I like the Homeland Lending setup that I am now. My underwriter, my processor, they're all in-house. So that's definitely something, I don't know really how you can do homework on that, but you could maybe ask your potential loan officer where their processing underwriting is held. Again, mine's in-house. That's one thing. Obviously, interest rates, you want to be savvy on that. I wouldn't get too hung up on that because the devil's always in the detail, I guess you can say.
That's true. Yeah.
So, you might...
Fine print.
Fine print, closing costs, etc. So that's important to look at. The level of involvement, face-to-face. Do you like to work online? So a lot of these companies are online. You might not even speak to someone, like the same person, more than once. You might.
Are there brokers that will specifically just do online only?
Sure. There's about a dime a dozen. So they're definitely out there. Companies you've never heard of. You go online. They might kind of get you in the door with the teaser rate. When you find out the full details, it'll probably be the same or maybe even worse than what you could have been offered at the, calling myself or someone, more well known.
So the devil's in the details.
Mm-hmm.
Are there different types of loans that people can get, whether they are through a more independent person such as yourself or a larger company like Wachovia, Caldwell Banker, so on?
In terms of product types, we all know the 15-year, 30-year loans. Everyone kind of just assumes 30-year loans is what everyone's going to do.
Is that what most of your clients do? 30?
Yes, but it's again, there's no two people are the same. So you might have someone with a short-term goal. I've had just a business executive from actually overseas. They're not going to be here too long. I did what's called an adjustable rate mortgage. Their timeline is anywhere from 3 to 5 years. We did an adjustable rate where the rate's going to remain the same for 7 years if they happen to stay that long. They got a little lower rate for that. That's a better product for them because they're not going to be here for 30 years.
Adjustable you're referring to, correct?
That's correct. That's the adjustable rate mortgage for that individual.
As opposed to fixed. Fixed rates tend to be a little higher.
Correct.
Because you're locked in, correct?
Correct. So
Okay.
To get a rate that could possibly go higher in the future, you'll get a nice introductory rate. So to get a fixed rate, you have the security of knowing what your payment is from year 1 to year 30. Adjustable rate mortgage, it's going to be locked for a certain amount of years. Usually 3, 5, or 7 is the most common.
So it's kind of like a risk reward thing. Take the risk and get the lower rate, or play it safe and pay a slightly higher rate.
Correct.
Okay, so other than a 15 or 30 year or even an adjustable rate mortgage or products, as you said earlier, what other special programs or services are there available to consumers?
On my end, we definitely have a little bit more leeway than your traditional big bank. Self-employed borrowers, they tend to not always document all their income, but it definitely is there. And I'm not saying we do loans that don't make sense or that are kind of turning a blind eye. However, if we see somebody getting a ample amount of deposits into their business checking or personal checking, we kind of know it's there, and their accountants can possibly write more items off. We're beyond those days. However, if you have someone with a significant down payment, they're self-employed, maybe they just took over a business last year. So traditional means they might not be able to go to a big bank. We have products, investors that definitely can help out. Okay, for example, I'll give you an idea of what I mean by that. I had a couple. They actually came abroad from. I think discussing this briefly. They came from another country. We were actually able to use their income from overseas as well as employee contract that they had over here. I know from my big banker days that wouldn't fly. It was kind of and actually where it was referred to me from one of my colleagues that I used to work with. He's still at the one of the larger banks. So that's one example. Another example, kind of going back to self-employed individuals. I had someone who was a mechanic for 25 years, bought the business. After 1 year, he tried to refinance his home. Big bank says you have to be 2 years employed. We actually were able to get him approved based on him being 25 years in the same industry and 1 year self-employed. So big bank 2 years, we can do 1 year on that product.
1 year income, correct?
Correct. That's what I meant. 1 year of income.
Gotcha. Now, do you primarily deal with residential accounts, or do you do residential and commercial?
Primarily residential. On the commercial end, I'll do something called a mixed use, where you might have a convenience store, insurance company, nail company, etc. On the first level, above will be apartments. So that's kind of the mixed use commercial that I do. Otherwise, primary, secondary investment homes where it's residential 1 to 4 family.
What are some common mistakes that first-time home buyers make when purchasing a home?
I think number one is not getting a pre-approval. So you're kind of jumping into the whole buying process without knowing your budget. That's primarily the number one mistake that I see. Other items where you're involved in the process already, we actually have like a 10 commandments at work, and we send it to all of our borrowers. Thou shalt not purchase a car, run your credit. These little things could come back and really bite you along the process. So if you're buying a car, for example, now your debt to income ratio, which we can elaborate that a little bit more if you want, but your approval might change if you do stuff like running your credit, purchasing cars, and other items like that. So I see that mistake quite often. But I think not having a pre-approval and kind of jumping right into the buying process, you find the beautiful home and then you get approved. So that's mistake number one that I usually see.
When purchasing a home, what is one of the first things that people should know about their situation?
Your budget, how much you can afford. And that's just that doesn't go down to just a mortgage based at X percent. Taxes, electricity, these are all important factors. You don't really think about those, like the taxes, your water bill, your electric bill. These things all add up. And how much you can afford. So are you going to look at that $400,000 house or the $350,000 house? Is this going to be a house for you to stay in for the next 5 years, 10 years, etc.? My wife and I got married. We bought a 1-bedroom condo. We had a daughter really quickly after that. So that 1 bedroom became very small. So are you someone who wants a family? Our school's important. Tax is important. So these are all important things to ask yourself before going into the home buying process. A big part of it is your lifestyle now and the near future. Are you someone who wants to go out and mow the lawn? Did you factor in paying a landscaper $100, $200 a month to be cutting your lawn? Condo, that might be perfect if you don't want to do any of those things.
Especially if you're a person that has a job that involves traveling a lot and you can't necessarily be bothered with cutting the grass, trimming the hedges, and whatnot.
Yeah,
so
you have a 12-hour day. Do you want to be out on your 1 day off cutting the lawn?
I know I don't, and I don't have 12-hour days.
Yeah, exactly.
Yeah, I gotcha. Well, it's just like anything else. Purchasing a home is not for everybody. You really got to put the time into it. It's a living, breathing thing to make it work and to make it flow, especially if you live with somebody. Splitting the expenses. I know you had mentioned the utility bills and the water and any miscellaneous expenses like landscaping or painting or anything like that. So I think a lot of times people will get wrapped up in the curb appeal of a house and they kind of bypass the fine print, as you had mentioned earlier. I mean, I know my situation was a little unique because I moved in with my girl and we purchased the home through them. But for people that are moving into a home for the first time or have never owned a home, the commitment of it can be scary.
There's a lot that goes into it. Can you paint? Are you handy? I mean, how many times have you painted in your life? I mean, flooring, windows, that really adds up quickly. So if you're not someone who maybe renting's for you or a condo's for you, maybe you're not ready.
How do you figure out what people can afford or comfortably afford when purchasing a home?
Okay. Well, we have something that we use called the debt to income ratio. This is based on your gross income. So if you make $1 gross before taxes, you basically can lend 50% of that.
Gross income, not net income, correct?
Correct.
So if you own a business and you have a lot of expenses, what you're looking at is how much are they bringing in, not how much are they keeping, correct?
That's correct.
Okay.
Which is important too to note because 50% sounds a lot different when you factor in 401ks, your taxes, all those other expenses that aren't included into that. That 50% is actually much higher if you look at it that way. But that's the debt to income. So if you make $100,000, your income is basically $50,000 in that sense, and then $50,000 over 12 months, you're basically looking at $4,000 a month in expenses. That's going to include your taxes, your homeowner's insurance, any credit cards you have, monthly payments, car loans, student loans. Those are all factoring into that 50%.
What about your credit history? Is that a factor?
Everyone has something called a FICO score. There's three major credit bureaus. What banks do is we'll look at the middle score out of those three, and that absolutely can affect your interest rate. Just to kind of give you an idea, what's a good score to have, and these are probably ones that are advertised, through the roof credit scores of 740 or higher. That's probably considered excellent. If you were in grade school, that'd be an A plus. And if you start going down to 700, you're going to see little adjustments to the interest rate. So it definitely plays a factor. In terms of the lowest score that you can be, I've seen programs where 500 FICO scores get approved. You are going to pay much higher rate, as you can imagine, being a much lower credit score.
So lower the FICO score, the more, is it risky? Is that the term you guys use?
Yeah,
more risky the loan is, so therefore the rate would be higher?
Correct. So if you're at a 500, chances are you had some kind of hardship, or you've missed payments, you've been late, whatever the situation is. There were accounts that were closed, delinquent. That's why you're going to be at 500 versus someone who's 740. They're pristine. They probably haven't missed a payment in 10 plus years.
All right, let me ask you a question, Luke, and this might seem a little odd. Do you take emotion into consideration when it comes to people's scores? Because you had mentioned earlier that you approved somebody that was sitting at about a 500, which I think is average or close to poor. If somebody is making a decent amount of money and has a good living, or has been at a job for 15, 20 years, but legitimately forgot to pay a couple of credit card bills, or they fell behind on something or whatever, how much of a determining factor is their story, and I'll put story in quotes, in kind of doing damage repair? Or do you guys just look at the number and be like, all right, well, Mr. Smith is sitting at a 500 and Mrs. Jones is sitting at a 700, so we're going to go with Mrs. Jones? Do you ever take their situation into account? Like their stories as to maybe why they're at a 500 when they really are responsible with their money, if that makes sense?
Overriding factors, I guess, that's what you're looking at.
Thank you.
Sure. Well, these people, they know their scores are low for X amount of reasons, and I'm probably not the first one who is telling them it's a 500. If you're at a 500, you've definitely had a couple issues over the years. The person who was a 7 or 800 and now they're a 640, sometimes a spouse is in charge of bills and they're not paying. I've come across that a few times. So in terms of emotions with that, it's not really emotions, but in terms of overriding factors to get them approved. I think that's what you asked. They're going to be told no at the bank. It's going to be black and white. I have other investors I can go to, so if it doesn't necessarily fit our guidelines, I can kind of go around and shop that a little bit. But the hardship cases, maybe a divorce, a death, we do have programs that will kind of look that into consideration, like a fresh start program, if you will.
What about bankruptcy?
Bankruptcy.
Is that really like the absolute worst, or the bottom line for your credit score? Example: somebody starts a business and they realize that they're not business savvy, and Lord knows there's a lot of them out there, and they declare bankruptcy. And then later down the road, they want to purchase a home, and they have the means to do so. How important does bankruptcy figure into this equation?
The common number of people associate bankruptcy is 7 years. It stays in your record. So if this is something that happened 10, 15 years ago, I wouldn't even look at it. There might be a checkbox that says, have you ever declared bankruptcy? Most likely will say something about 7 years. But in terms of that individual, if he's under the 7-year time frame, I have seen programs where after 2 years, that same individual will be able to go out and purchase a home. So it's actually, bankruptcy might not even be the worst example. Someone who is really trying to not go bankrupt will just kind of stay at that low credit score for years and years and years, trying to make payments. He'll pay one payment, miss a few payments, make one payment. He actually, after everything's said and done, 2-3 years later, he's probably worse off than the guy who did go bankrupt. Fresh start, if you will.
Did you see a lot of that in the recession, 2008, 2009? Did you see a lot of that, like people just basically just giving up?
Well, a lot of people just turned their keys in. They just basically gave the keys back to the bank. So I did see that a lot. In terms of frustrating factors that made people do this, number one, they shouldn't have qualified. That's the most important thing. They shouldn't have been getting the homes. The second thing is, if you bought a house for $500, go to sell it for whatever reason. Maybe you couldn't make the payments, or you're moving. Now the house is worth $400,000. That's so. What are you going to do at that point? You have a home that's underwater. You can't make the payment. You're moving, etc. So I did see that quite often.
It's very sad. People basically evicting themselves from their own home because of what happened. They took out a $400,000 mortgage, and their house is not even worth $400,000. It's a very sad situation. In more recent months or recent years, have you noticed the big turnaround?
No, the market got hot, and going back to those people who were underwater, there was some programs that came out for about a 4-year span. I guess it's been now, called a HARP loan. So those people who are underwater, maybe they don't have the best equity, best interest rate. If they've made all their payments on time, there are programs out there where they can actually refinance, even if they are underwater. So select 2009 and prior to that, so those people can actually refinance.
So from your perspective, what the hell happened? Why did everything just kind of go belly up? Were people getting mortgages that they shouldn't have, or?
Well, everybody was fulfilling the American dream. Everybody was getting approved prior to, who probably shouldn't have gotten approved. Just to kind of give you an example, I remember, I guess this is 2004, 2005, just pulling someone's credit, and based on that credit score, no income or assets were required. So that's pretty problematic if you ask me. Not really only looking at someone's credit score, not looking at how much income they actually had at that point in time. That was a typical example, pre-2007, I guess you can say.
So it was a buildup of those type of situations is what eventually caused it to go belly up?
Yeah, and that's a culmination of people who weren't getting approved for loans, appraisals coming in astronomical year over year. So, for example, one house might sell for $300,000 in 2004. Next year, 2005, it's went up $50,000, and that trend continued year after year for quite some time. People just got tremendous gains in the equity in their homes.
When did it kind of plateau? Right around spring 2006, like in that area?
Yeah, I kind of lose track of the years a little bit now, but it's I'd say 2006 is kind of was maybe the peak. It was coming down by that time, maybe even backtrack a couple of years, even 2004. I'm trying to think of my condo again because I feel bad for the woman who bought it. I think I got it for $190, sold it for $280, and now it's 15 years later, that same thing is back to $180.
How long did you live in the condo before you sold it?
About 3 years.
Oh, so you turned a nice profit in 3 years.
Yeah, not bad at all. Wish I could have done that with a few more condos. But then again, the same guy who bought it a year after me, he bought it for $220, $230, and he probably couldn't get that now.
So it's about timing, being in the right place at the right time.
Yeah, absolutely. If your place to live and it meets your standards, my goal is 5 years, 10 years, etc. I don't think you should look at it as I made $50,000, $100,000. Because it's all money that you can't really appreciate until you did sell it.
Well, one person's loss is another's gain, and vice versa.
Mm-hmm.
As you mentioned, you felt bad for the person that bought it, but you made a decent chunk of change yourself off of that transaction.
Yeah, and if I didn't have my daughter, I probably would have been the one. No equity would have been realized probably, because I probably would have stayed there for more years and then would have went right back down afterwards.
All right, so let's bring things up more to modern times. The magic number for a down payment seems to be 20%. Now, I know 20% might not seem like a lot, but as the old saying goes, a small piece of a large pie is still a lot of pie. For those who can't necessarily afford a 20% down payment on a home, whether it's a house, a condo, townhouse, whatever, what options do people have in that scenario?
Yeah, it's funny you said that 20%. It's still what people expect to have to pay. So 20% down on, let's just say, a $300,000 home, that's 60 grand. So that's pretty significant. What people don't realize is you can do loans for as low as 3% down. So something on $300,000, now you're looking at $9,000. So significant difference there. There are a lot of first-time home buyer programs, 3.5% down. When you drop below 20% down payment, you're going to pay what's called PMI. So it's private mortgage insurance. And what actually happens is you'll continue to pay that private mortgage insurance. That might be anywhere from $100 to $200, depending on the size of the loan. you'll continue to pay that until you've gained enough equity in the home where that will just drop off. And that happens at 20%.
And that's per month, that $100 you mentioned per month, correct?
That's correct. That's a monthly payment.
Okay.
In addition to your mortgage, taxes, and homeowner's insurance.
Was there ever a situation where people had just barely enough to get to the 20%? Like if they wanted to purchase a $300,000 house and they had to put 60 grand down, but they only had like 54?
It happens. You're gonna pay that.
You're still gonna get hit with the insurance?
Correct.
Oh man.
But you are gonna get rid of it much quicker than the guy putting down 3 or 5%. Because
there's equity back in the house
eventually,
correct. So right?
You have 18%, let's just say, built up. You're closer to getting to that 20%. Your mortgage insurance, you either don't have it or it's gonna drop off quicker the closer you are to 20% initially.
You ever deal with anybody that paid anything in cash, 100%?
Well, they wouldn't need a loan officer then, would they?
They seem like the type of people that don't want to answer questions, if you catch my drift.
Yeah, no, but I have helped. I do work with attorneys, title companies, so no, they're out there, and cash is king. By the way.
Don't we know it?
So I mean, that you actually bring a good point up with the cash buyers. I've said pre-approval, I don't know, 3-4 times in this podcast, but pre-approvals are huge because cash is always king. So let's just say that you're buying a home, I'm buying a home. Buyer is going to look at the cash deal as number one priority. Second thing they're going to do is look at if the borrower is pre-approved, the buyer I should say, pre-approved. If you're not pre-approved and you tell me you're going to put 50% down, I will take a smaller offer if I'm the seller, a smaller offer with somebody who's pre-approved. So that's, I'm glad you mentioned that, cash is king before.
Well, now why does that matter? If you said a seller would be kind of more apt to accept a cash offer from a buyer, but if a buyer is still receiving money, regardless if it's from a seller or from a bank, what does it matter?
Well, timing of the closing, something happens. I've had loans where people have lost their employment a week before closing. Well, why would the seller be less apt to go ahead with a non-cash deal? Is that what you mean?
Yeah, I mean, let's say I want to sell my house, and person A wants to buy it for $500,000, and they're willing to pay for it in cash. Okay. And person B is just going to put down 20%, go through somebody like yourself, but they are going to offer me $520,000. Now, explain to me why the $500,000 is a more appealing offer in cash. What does it matter? Why
unless they lose their suitcase with the $500,000, they're approved. You don't have to worry about approval. So versus the guy paying $520, like I mentioned, the one example of someone losing their job a week before closing, it does happen. You really never know.
That sucks.
Yeah, but if you're not in a time crunch to get rid of the house, I mean, maybe look at the $520. But if they're not pre-approved, I think it leans back to the $500. So if you're $520 fully approved, I'll take that offer versus the cash, and then it kind of goes down to your how fast you do want to close.
So if you're in no particular hurry, then you have the luxury of time on your side, and you can wait for that $520 to come in as opposed to the gangster that wants to pay $500,000.
Yeah, and another thing with like these pre-approvals, you gotta watch out for what's called pre-qualified. Pre-qualified is a banker ran your credit and they're taking your word on the income. They haven't gone over conditions, etc. So that's like a third category. So you have cash, full pre-approval, and the pre-qualified. Pre-qualifieds, realtors, sellers, they don't really even take those seriously, honestly.
Okay.
That's the very bottom. So pre-qualified, again, you pull your credit, give the banker an idea of what you're making, but you actually don't provide documents. Pre-approval is going through the full underwriting, getting every question answered. So that's cash, then pre-approval, and then pre-qualified if you went in order.
Kind of in closing out here, what are some tips that you can recommend on making the purchase process as smooth as possible between the buyer and somebody like yourself, a broker, or a banker?
Yeah, just changed again. So thanks for picking up on that. But the pre-approval, now it's like the 5th time I'm saying that. That's number one. Be realistic with your budget. If the bank says you can afford $400,000, don't go out and look for $400,000 because you make sure you factor in all those additional
expenses, property taxes,
utility expenses,
Right.
taxes, your lifestyle. Just with, are you willing to do all those home improvements like we talked and touched on? Household, like maybe if I did it over, I would have bought the 2-bedroom condo instead of the 1-bedroom condo to start with. So just factor in all those to your lifestyle, and I think give me a call with any questions. I'll be here to take your phone call.
Well, I know for people that are listening, don't know the relationship between both of us. It was almost 2 years ago. 2 years ago, in a couple of weeks, that you actually helped facilitate the home that I currently live in. You took all the stress out of it. When me and my girl were here, it's a commitment. It really is. I mean, granted, our situation was a little different where her parents moved out and I kind of moved in, and it was just like more of a simple transfer. But, we still had to go through the motions of getting a lawyer. We had to speak to somebody like yourself, not that we didn't enjoy your company, but it was just stressful. I totally understand that it's stressful, but you made the process very easy. You broke it down into very simple terms. You're just like, listen, I need this form from you. I need that form from you. I still remember like it was yesterday. And I remember not being freaked out the entire time. And, some people will be freaked out prior. They're essentially spending probably the most amount of money they'll ever give to somebody. I know it sounds weird, but the experience was like somewhat enjoyable, because you're just like, all right, I need this form. Here you go. All right, well, now I need this form. All right, fine. And everything, just like I said, it went silky smooth. And I can't thank you enough for kind of simplifying the process there. And
you're welcome.
If it wasn't for you, I'd probably still be living with my dad.
No, you're very welcome. And I definitely use the golden rule with all my customers. So it's treat people how you want to be treated. I'm glad you had a great experience, and it's just what I want to do for all my customers. It's a stressful process. You want to make it as easy as possible. Always make myself available, answer any questions. And I have to kind of step back and remember every single time. I may speak to Ed today, but tomorrow I might be speaking to Ed's brother, who's going to be starting from scratch. So I definitely have to take that in consideration. And it was a pleasure working with you.
Thank you. Luke, how can people get a hold of you? How do we find you?
I don't know if you're going to post this on Facebook as well, a link.
I will.
Okay, I'm sure it'll be on there. My contact info, my cell phone number, 201-739-4448. Again, the company Homeland Lending. And my name is my email is Luke@Homeland Lending. I'll be happy to answer any questions for you or any friends, loved ones, etc.
All right. Well, I'll put the link for your email address and phone number on my SoundCloud and Instagram account, so people can hopefully get a hold of you that way. So, Luke, my man, thanks for coming on. You did a great job.
Thanks for having me, Ed.
All right, everybody. And that's the podcast. I want to thank everyone for listening to Victory Loves Company. I'm Conrad Agderian. If you like what you hear, please rate and review us on SoundCloud or iTunes or wherever it is that you listen to podcasts. Also, please check us out on our Facebook, YouTube, Instagram, and Twitter handles at VLC Podcast. And as always, if you have any questions or suggestions for upcoming shows that you'd like to see addressed, please email us at thevictorypodcast@gmail.com. And I'll talk to you next week.